Most people in Singapore are still asking the same few questions. Should I buy a condo? Should I wait for the prices to drop? Should I enter new launch or resale? But while everyone is looking at residential property, something very interesting has been happening quietly in the industrial property market. In today's video, I want to walk you through the full thought process. Why selected industrial properties may have potential upside. What is the difference between B1 and B2 industrial properties, using examples that we can all relate to. Why some factories are moving production to Malaysia and Vietnam, but Singapore can still remain relevant as a business hub. Who the future buyer may be, especially the SME owner who grows from renting to owning. Why Citigo will snap up so quickly, and what upcoming projects like Gate Plus, Space Nova, Space 18 and Generations at Tannery may tell us about the next wave of industrial opportunities. So stay with me till the end, because the key question is not simply whether industrial property looks attractive today. The question is, if you buy the right industrial unit today, will your future tenant or future buyer still see the value when it's time for you to exit? And before I begin, let me first make this clear. This is not a financial advice, and this is not a blanket recommendation to buy any industrial property. Industrial property is very different from residential property. You need to understand zoning, approved use, GST, financing, floor loading, ceiling height, ramp-up access, tenant demand, seller stamp duty, and exit strategy. So the idea of this video is not to say industrial property is always good. The real question is this: can the right industrial asset in the right location with the right specifications at the right entry price become a powerful part of your property portfolio? Because in real estate, the biggest mistake is buying something you do not understand. So today, let's understand industrial property properly. Let's start with the big picture. In Singapore, residential property has always been the favorite asset class. Most buyers understand HDB, condos, new launches, and landed homes. But residential property also comes with cooling measures. For many buyers, ABSD can be a very painful number. That's why investors begin to look beyond residential and start studying commercial or industrial property. For industrial property, the attraction usually comes from a few areas. There can be a lower entry quantum compared with many residential properties. There can be potentially high rental yield. Business owners may prefer to own instead of renting forever. Selected freehold industrial assets are rare, and some locations may benefit from transformation, trade, logistics, and business activity. But again, not every industrial property will perform. Poor exit liquidity may not attract strong resale demand. So when we talk about upside, I'm not talking about any factory. I'm talking about modern, functional, well-located industrial assets that solve a real business problem. Because a factory is not just four walls, a good industrial unit must answer very practical questions. Can the tenant operate there? Can goods move in and out smoothly? Can the ceiling height support the business? Can the floor loading take the weight? Can the locations support staff, customers, suppliers, and logistics? These are the details that decide whether an industrial unit is merely cheap or genuinely valuable. Now let's look at what the market is showing. In Q1 2026, Singapore's overall industrial occupancy improved to around 88.9%, while industrial rentals rose at a moderate pace of 0.4% quarter-on-quarter. Colliers also noted that JTC All Industrial Rental Index has posted 22 consecutive quarters of growth by Q1 2026. Rents were up 26.5% from the Q3 2020 trial, and the Industrial Price Index was up 30.9% from its previous trial. So, the market is not exploding like a hype bubble, but it is showing something important. There is resilience. Rents have been gradually climbing, prices have been moving up, occupancy has been stable, and tenants are becoming more selective. That last point is very important. Tenants no longer just looking for the cheaper space, because many businesses now want better specification. They want easier loading and unloading. They want higher ceiling, they want ramp-up access, they want newer buildings, they want better corporate image. They want convenience for staff and customers. So this is where newer strata industrial properties may stand out from the older stock. Because in today's market, a tenant may not only ask, how much is the rent? They may ask, can this space help my business operate better? And this is where the quality of the industrial asset becomes very important. Not all industrial properties are the same. In Singapore, Industrial properties are broadly classified into B1 and B2 use. Clean and light industries are generally allowed in Business 1 or B1 zones. General and special industries are to be located in Business 2 or B2 zones. Now, allow me to cite some examples to let you better understand the differences. The next time you order food delivery, maybe through GrabFood or Deliveroo, so ask yourself, where does the food actually come from? For some brands, the food may come from a central kitchen or a food factory. And inside that space, there may be cooking, preparation, packing, cold storage, delivery coordination, exhaust, grease traps, loading and unloading. So, would this usually be B1 or B2? Typically, if there is proper cooking, food production, stronger equipment, smell, exhaust, grease trap, and delivery movement, it will usually be suited to a B2 environment, subject to approvals from the relevant authorities. But if it is just a light food packing or clean packaging, then the classification may be different, depending on the actual operation. So the question is not just, is this a food business? So the better question is, what exactly is happening inside the unit? Are they just packing, or are they cooking, processing, and producing? Another simple example, if you send your car to a workshop for servicing, repairs, tire change, spray painting, or mechanical work, what kind of industrial space do you think this belongs to? Usually this is more likely to be a B2. And why? Because car workshop may involve noise, machinery, fumes, oil, repair work, and heavier operations. So it is very different from a clean design studio or back-end office. Now let's look at B1. Imagine an interior design company. They may need a space for their designers to work. They may need space to store tiles, vinyl samples, laminates, lighting catalogs, and carpentry materials. They may also need a small display area where clients can see how the materials look in real life. This type of business may not need a heavy factory environment. A B1 industrial space may make more sense provided the main use still supports the business operation and the usage follows the guideline. So a simple way to remember is this: B1 is generally cleaner and lighter. B2 is generally more operational and heavier. And this is also why the buffer distance matters. URA notes that NEA requires a 50-meter nuisance buffer from a B1 zone to the surrounding area. For B2, the buffer requirement is generally larger because the business activities may create more noise, smell, vibration, traffic, or environmental impact. So B1 can usually sit closer to residential or commercial areas because the activities are cleaner and less disruptive. B2 is usually pushed further into industrial clusters because the operations can be heavier. Now, there is another rule that many buyers misunderstand. Some people think, if I buy an industrial unit, can I use it fully as an office, showroom, or retail space? The answer is no. Industrial land is mainly meant for industrial activities, and URA states that at least 60% of industrial GFA should be used for industrial purpose, while the remaining 40% may be used for ancillary or supporting uses. For strata subdivided industrial units, at least 60% of each unit should be used for industrial use, and ancillary use such as office, meeting rooms should not occupy more than 40% of the unit's floor area. This is why many people refer to the 60-40 rule. So let's go back to the interior design company example. If they take a B1 unit, they should not treat the whole space like a pure retail showroom or pure office. A more compliant structure may be 60% for industrial related, such as material storage, sample handling, design production, fulfillment, preparation or back-end operational work, and up to 40% for supporting use such as office, meeting area, client discussion space, or display area. When we compare B1 and B2, price is definitely one factor. But the deeper question is whether the zoning, the business use, specifications, tenant demand, and future exit audience all line up with the investment objective. Because if the business cannot legally operate there, then even a low entry price may become expensive later. Now let's talk about how factories have performed in Singapore's property landscape. In the past, many people thought factories were boring, but the market has changed. After COVID, many businesses start to rethink their space needs. E-commerce, logistics, fulfillment, food supply chains, light production, engineering support, storage, distribution, and SMEs all need physical space to operate. But not all factory spaces benefit equally. Older industrial buildings may still have tenants, but they may face limitations like lower ceiling height, poor loading access, no ramp up, limited parking, older facade, harder movement for goods, less efficient layouts. Modern factories, on the other hand, are designed for today's business needs. They may offer higher ceiling, better floor loading, ramp-up convenience, better goods access, newer facade, better power provision, more practical layouts, and stronger corporate image. That is why when we look at projects like CityGo, Space Nova, Space 18, Generations at Tannery, and Gate Plus, we are not just looking at factory space. We are asking whether the building fits the way modern SMEs operate. And in today's SME may run e-commerce, showroom, fulfillment, storage, back-end office, design work, and operations within one space. So the unit must be flexible, practical, and accessible. That is why newer industrial projects with better specification can attract stronger attention. Imagine you are a business owner. You need space for storage, packing, display, staff workstations, and maybe even customer visits. Would you rather operate in an old dark building with low ceiling and difficult loading? Or would you prefer a newer building with higher ceiling, better access, and more efficient layout? This is why industrial specifications matter. So, when buyers compare factories, I will look beyond PSF and ask better questions. Can the tenant use the space efficiently? Can goods move in and out easily? Can the tenant maximize airspace? Can the business present itself professionally? Can the unit attract both investors and owner-occupiers? Because two industrial units can be in the same district, but it can perform very differently. One may be lower in price and harder to rent. Another may look more expensive on PSF, but it's easier to lease because the specifications are stronger. Now let's talk about yield. This is one of the biggest reasons investors look at industrial property. For residential properties, rental yields can sometimes feel compressed, especially when the purchase price is high. For industrial properties, because the entry price can be lower and rents can be stronger relative to price, gross yields may look more attractive. The formula is quite simple. Gross rental yield equals annual rental income divided by the purchase price multiplied by 100. So for example, if a unit costs 1 million and it's rented out at 4,500 per month, the annual rent is 54,000. So the gross yield is $54,000 divided by $1 million, which gives 5.4% gross yield. But here's the important part. We cannot only look at the headline yield, we must check whether the rent is realistic. Nearby rental references vary widely. Some older factories are shown around $2 to $2.60 per square foot, while newer or better positioned examples can go higher. City Hub at around $4 per square foot. CityGo sales kit rental range around $4.20 to $4.80 per square foot, and AZ at Paya Lebar around $3 to $5.70 per square foot. And this is why industrial yield is not one size fits all. A lower price unit doesn't automatically mean better investment. A higher PSF unit does not automatically mean poor investment. So the real question is, what rent can the unit realistically command? How long will it take to find a tenant? What type of tenant can use the space? Is the tenant pool deep? Are there competing buildings nearby? Is the rent based on actual transaction or just marketing projection? So for Gate Plus, the marketing material highlights units from below $1 million and projected rental yield of up to 7%. For video's sake, I will phrase this carefully as projected yield of 7% is subjected to rental assumptions and unit selection. Now between B1 and B2, which gives better yield? There's no fixed answer. Generally, B2 industrial properties can sometimes show stronger gross yield because the entry price may be lower and the tenant users can be more operational in nature. For example, B2 users may need practical space for logistics, engineering, warehousing, manufacturing support, food production, vehicle-related work, or heavier operations. If the building has container access, high ceiling, ramp-up access, and good loading, it can be attractive to businesses. But B2 also requires more careful checking. What kind of use is allowed? Does the tenant's operation fit the building's rules? Are there environmental nuisance or safety restrictions? Will future buyers also want B2 use? For B1, the yield may sometimes be slightly lower, especially for freehold city fringe projects, because the land and entry price are higher. But B1 may attract a broader SME profile that wants cleaner use, better image, and city fringe convenience. So I would summarize it this way. B2 may appeal to yield-driven buyers looking at more operational use. B1 may appeal to buyers who want clean industrial use, city fringe positioning, and freehold scarcity. But the best investment is not simply B1 or B2. The better question is whether the unit specification match the tenant demand and the future exit audience. Now let's zoom out from the individual unit and look at the Singapore growth story. Industrial property is not just about one factory unit. It is about Singapore's role as a trade, logistic, manufacturing and supply chain hub. This is where the Tuas port becomes important. Tuas port is planned as a mega port that will occupy about 1,337 acres of land when completed, with 66 berths spanning 26 kilometers. It is part of Singapore's longer-term plan to remain a major global maritime and logistic hub. But the more interesting part is not just the port itself. MPA described Tuas Port as part of a wider port industry ecosystem connected to the western region, including Jurong Lake District, Jurong Innovation District, and Tuas Industrial District. So when we talk about industrial property in the west, especially around Jurong and Tuas, we are not just looking at one building. We are looking at wider economic infrastructure. Tuas Port supports trade. Jurong Innovation District supports advanced manufacturing and innovation. Jurong Lake District supports business, office, and commercial activity. Tuas Industrial District supports heavier industrial activity. Every parcel you receive, every product that is imported, every food brand that needs a central kitchen, every SME that needs a storage or production, every logistic company that supports trade, they all need physical space somewhere. This is why industrial property can be interesting, not because every industrial unit will surely perform, but because Singapore's economy still needs real operational space behind the scenes. And I know some investors may be thinking and ask, Sandra, if factories are moving out of Singapore to Malaysia or Vietnam, then why are we still talking about industrial property? Well, this is a very fair question. We have seen examples like Gardenia shifting bakery production from Singapore to Johor Bahru, Tiger Beer's large-scale production moving to Malaysia and Vietnam, and Yoast relocating some manufacturing operations to Malaysia. So yes, we cannot ignore this trend. But instead of stopping at the headline, we also need to ask, why is this happening? For large-scale manufacturing, companies will need bigger land plots, lower operating costs, more labor flexibility, larger production lines, and more room to scale. But for some businesses, Malaysia or Vietnam may make sense for mass production. But that does not mean Singapore has no industrial demand. It means Singapore's role is changing. Singapore may not always be the cheapest place to run a massive factory, but Singapore remains a business hub, regional HQ hub, logistic hub, sales hub, R&D hub, quality control hub, and decision-making hub. So in fact, for Tiger Beer, even when large-scale brewing is shifting out, reports also mention that Singapore will continue to play a role in regional commercial operations, logistics, innovation, and R&D leadership. So the demand does not disappear, the demand changes. Large production may move to where land is bigger and cost is lower, but Singapore still needs smaller, high-value operational and business support spaces. And this is where the smaller strata industrial unit becomes interesting. For industrial investors, unit size becomes very important. If you are buying a massive industrial building and depending only on one large production tenant, your risk profile is very different. But if you are looking at smaller strata industrial units around 1,500 to 3,000 square feet, the tenant pool can be more flexible. These units may appeal to SMEs that need back-end operations, storage, light production, design and sample space, e-commerce fulfillment, distribution coordination, a small workshop usage, a sales support for a showroom plus operation setup that's subject to the 60-40 rule. So this is why projects in areas like MacPherson and Jurong can be interesting. MacPherson appeals because it is city fringe, is matured, familiar to some SMEs, and connected to a wide business network. Jurong appeals because of the wider transformation story, Jurong Lake District, Jurong Innovation District, Tuas Port, and the Western industrial ecosystem. So when we look at projects like Generations at Tannery, Space Nova, Space 18, CT Go, and Gate Plus, the question is not only about entry price. The better question is, does this unit size match the future SME buyer and tenant pool? Because the future tenant may not be a giant manufacturer needing a huge plot of land. The future tenant may be an SME that still wants a Singapore presence, but in a more efficient and practical size. Singapore's business landscape is actually powered by SMEs. According to SingStats 2025 enterprise data, Singapore had about 369,500 SMEs compared with about 371,000 total enterprises. So when we talk about industrial demand, we are talking about thousands of SMEs in renovation, interior design, e-commerce, fulfillment, food operations, logistics, light manufacturing, packaging, workshops, media production, engineering, and many other trades. Not every SME needs a factory, but many SMEs need some form of operational space. A startup may begin by renting a small office, a small storage unit, a shared kitchen, or a small workshop. But once the business becomes more stable, the owner may start asking, should I continue paying rent forever? Should I buy my own space? Can I control my operational costs? Can I build an asset under the company? Can this unit support my business today and maybe become an investment later? That is where the industrial property exit stories becomes interesting. When successful SMEs grow, some of them may eventually move from tenant to owner-occupier. And when they want to buy, who can they buy from? They cannot buy land that does not exist. They cannot buy freehold industrial supply that is not being created anymore. They have to buy from existing owners. So if you are an early investor who bought the right unit in the right location with the right size and specifications, you may become the future seller to these growing SMEs. Today they rent from you, tomorrow they may buy from you. In residential property, your future buyer may be an upgrader, a family, or an investor. In industrial property, your future buyer could be a business owner whose company has grown. And that business owner may not be buying based on emotion. Now let's come to CityGo. CityGo being sold within 2 days did not happen by accident. And I do not think it was only because buyers suddenly wake up and said, let's buy industrial property. A lot of confidence comes from buyers who were already familiar with the industrial market. These are investors, business owners, and bulk buyers who have already seen how selected industrial properties can perform over time. They understand rental demand, they understand scarcity, they understand replacement cost. They understand why freehold industrial land is not easy to find in Singapore. The take-up was driven largely by bulk buyers snapping up multiple units. When a rare freehold industrial property appears in a mature city fringe industrial location, serious buyers do not wait too long because they know that in Singapore, land is scarce. And industrial land is not something that can be easily recreated, especially freehold industrial land. So the story is not simply CityGo sold very fast. The deeper story is why were experienced industrial buyers confident enough to move so quickly? And to me, CityGo has a few important ingredients. First, freehold tenure. Second, a mature city fringe location in MacPherson. Third, modern specifications. Fourth, bite-sized units that appeal to SMEs and investors. Fifth, a developer with industrial and commercial experience. And sixth, limited comparable supply. This is not exactly a blue ocean where nobody knows about it, and it is not a red ocean where everyone is rushing in blindly. I would call it a rare pocket in Singapore's property market. Residential buyers may not talk about it every day, but industrial investors have been studying this space for years. So after CityGo's strong take-up, the natural question is, where are the next rare industrial opportunities? That is why the market is watching projects like Generations at Tannery, Space Nova, Space 18, Gate Plus. Not because we want to chase blindly, but because buyers are asking whether these projects carry the same ingredients, the scarcity, functionality, tenant demand, and a clear exit audience. Now let's also talk about how industrial property can follow the broader replacement cost story. When we analyze residential new launches, we often talk about land cost. If future land cost goes higher, future selling prices may also need to be higher. Industrial properties can have a similar logic, but we must be careful not to overstate it. Selected industrial assets can follow the replacement cost story, especially when future supply becomes more expensive to reproduce. But performance still depends on location, specifications, tenant demand, and asset liquidity. That is why the right comparison still matters. A freehold city fringe industrial asset may behave differently from an older leasehold factory in a less accessible estate. A modern ramp-up industrial project may appeal to a different tenant pool compared with an old flatted factory. A food factory project may attract a very specific type of tenant demand compared with a clean B1 project for design, media, or e-commerce operations. When the asset has the right location, specifications, tenant demand, and right entry price, the performance can be meaningful. But again, we are not saying every factory will perform. We are saying the right industrial asset can be very powerful when the business use value and the real estate value comes together. Now let's talk about freehold industrial properties. This is one of the most important points. Today, new government industrial land sales are generally leasehold, so future freehold industrial supply is not easy to create. New government industrial land sales are leasehold, and future industrial freehold land can only come through en bloc acquisitions. That means when a freehold industrial project appears in a mature location, buyers pay attention. Freehold industrial is not just about tenure, it's about the scarcity. When something is scarce, well located, functional, and still relevant to occupiers, the long-term holding story becomes more compelling. But freehold alone is not magic. A freehold asset in a poor location with weak demand may still struggle. The winning combination is usually this: freehold tenure, practical specification, a good location, real rental demand, and reasonable entry price. Because at the end of the day, the asset must serve both investors and real businesses. Now let's move to Jurong Lake District and Gate Plus. Gate Plus is positioned as a B2 industrial development at Tukang Innovation Drive near the Jurong Growth Story. Gate Plus is the first IGLS, which stands for Industrial Government Land Sales, and the next plot is positioned as 16% higher than Gate Plus. Some units are below $1 million, and Gate Plus is interesting because it combines three things: lower quantum, B2 industrial usage, and proximity to a major transformation area. B2 industrial can appeal to a wider range of heavy industrial users compared with B1, subject to approvals and regulations. And if the entry quantum is still manageable, it may attract business owners who want their own space as well as investors looking for rental yield. But buyers need to do due diligence. They must check tenant profile, approved use, rental evidence, GST, financing, maintenance, and whether the projected yield is based on realistic market rents. For Gate Plus, the key selling point is not only price. The bigger story is this: can a modern B2 industrial asset near the Jurong Lake District and Western Transformation area benefit from business decentralization and future occupier demand? That is the question buyers should ask. Because in industrial property, we do not only buy based on price. We buy based on utility, tenant demand, and whether businesses will still want this space years from now. Now, what are the next potential projects? The first one to watch is Space Nova at 21 New Industrial Road. Space Nova is a 7-story multi-user B1 clean industrial development with 47 strata units. The site area is about 36,257 square feet and the tenure is freehold. The floor-to-floor height of 6.5 meters on level 1 and 6.3 meters from levels 2 to 7. Floor loading is set at 7.5 kN per square meter, with 60 ampere electrical power for production areas. Space Nova as a freehold B1 project in District 19 near Bartley MRT, and launch is expected in early August 2026. It also highlights ramp up to level 3, separate ingress and outgress from 2 roads, and level 1 units that can function as production or showroom style spaces. Space Nova is one of the projects to watch because it sits in that rare category of freehold B1 industrial. And after CityGo's strong take-up, buyers who miss early opportunities may start asking, where is the next freehold B1 opportunity? Where is the next project with modern specs? But as always, we need to study carefully. Compare the specs, compare the entry price, compare the rentability, compare the future exit audience, and that is how we decide whether the opportunity is real. An existing project is Space 18 at 18 Lorong Ampas. Space 18 as another freehold B1 industrial project by JVA with 46 units and 1 canteen located in District 12. Ceiling height of around 6.3 to 7 meters, 7.5 kN per square meter floor loading, and all flatted configuration. According to the comparison, Space 18 is near to Toa Payoh MRT with bus stop access near Shaw Plaza. So what is interesting about Space 18 is that it sits in a central fringe location that is closer to TOP. For some buyers, they may not want to wait until 2030 or 2031. They may want rental income sooner. They may want to use the space earlier. They may want more certainty on the finished product. So for Space 18, it appeals to buyers who prefer a more immediate asset, while Space Nova and Generations at Tannery may appeal to buyers looking at the next wave of freehold supply. Again, the key is not only freehold. The key is whether the units can attract real occupiers. A project can be freehold, but if the layout is not functional and the rental may not be strong. A project can be smaller, but if the location, access, and specifications are practical, it may perform better than expected. That is why industrial property is very different from residential property. For industrial, buyers buy functionality, rental demand, and business use. The third project to watch is Generations at Tannery, the freehold B1 industrial project in District 13, near Mata MRT, with 54 production units and 5 canteen units. 12 stories, ramp up to the 5th story, and launch date is stated as 17th of July 2026. Generations at Tannery as a rare freehold B1 industrial in District 13 with ramp up to the 5th story, city fringe, McPherson cluster, modern specification, ramp up, convenience, limited new supply. Generations at Tannery will likely attract attention from buyers who miss city go. Now, one more important point. Even though we talk about freehold scarcity, the government is still releasing industrial land to support economic growth because new industrial supply is still coming, but much of it is leasehold. So buyers may understand the difference. Leasehold industrial may offer lower entry price and functional use. Freehold industrial may offer scarcity and longer-term holding value. B1 may suit cleaner users. B2 suit heavier industrial users. Ramp-up may command stronger operational demand. Flattered factories may appeal to different users. So the opportunity is not simply freehold good, leasehold bad. The opportunity is knowing which product fits which buyer and which tenant. And that is where the real advisory comes in. A business owner may look at monthly mortgage versus rent, operational efficiency and long-term control. An investor may look at yield, tenant demand and exit strategy. A tenant may look at access, loading, ceiling height and convenience. When you understand all these different perspectives, you can make a much better property decision. Before anyone buys industrial property, please check these items, GST. Some industrial transactions may involve GST depending on the seller's GST registration and structure, and this can affect cash outlay. Financing. Industrial financing is different from residential financing. Loan quantum, interest rate, tenure, and borrower profile matters. Do not rely on projected yield. Look at the nearby transactions, the age of the comparable buildings, the ceiling height, whether the rent includes airspace, tenant profile, and lease terms. Exit strategy. Who is your future buyer? An investor, a business owner, a foreign buyer, a company looking for own use, a tenant who may eventually buy. So when you understand the exit buyer, you understand the asset better. Because every property must answer one important question. Who will want this after me? If we cannot answer that clearly, then the investment may be risky. So when I speak to buyers, I usually explain it this way. If you are an investor, the question is not only what is the yield, the deeper question is the yield sustainable? And if you are a business owner, the question will be, will this space help my business operate better and protect me from future rental increases? And if you're buying for long-term wealth preservation, the question will be, is it freehold? And the deeper question is this freehold asset still relevant to future tenants? Because industrial property has two layers of value. The first layer is the real estate value, which is the location, tenure, land scarcity, transformation, and pricing. The second layer is the business use value. Can real businesses use it, pay rent, grow in the space, and operate efficiently? And when both layers are strong, this is where industrial property can become really interesting. So to summarize today's video, industrial property is getting attention because of no residential ABSD, potentially stronger rental yield, business owner demand, and the rarity of selected freehold industrial assets. B1 and B2 industrial properties serve different tenant pools. B1 is generally for cleaner and lighter use. B2 is generally for heavier and more operational use. Factories moving out of Singapore is a real concern, but the deeper story is that Singapore's role is changing. Large-scale production may move to Malaysia or Vietnam for cost and land reasons, but Singapore remains a business hub, a logistic hub, regional HQ hub, R&D hub, and decision-making hub. SMEs are also a major part of Singapore's economy. When SME grow, some of them may move from renting to owning. And when they want to buy, they need to buy from existing owners. So, if you enter early into the right industrial assets, you are not just buying for today's rent, you are positioning yourself for the future SME owner-occupier who may want to buy when their business is ready. Today they rent from you, tomorrow they may buy from you. City Gold sold quickly because it has the right combination. Freehold tenure, city fringe, McPherson location, modern specification, manageable unit sizes, and strong demand from experienced industrial buyers. And the next projects to watch include Gate Plus in the Jurong Grove Story, Space Nova at 21 Industrial Road, Space 18 at Lorong Ampas, and Generations at Tannery in the McPherson and Tannery cluster. But please remember, the upside is not buying in any industrial property, the upside is buying the right one. Right location, right specs, right entry price, right rental demand, right holding plan, right future buyer. If you are a business owner wondering whether to continue renting or buying your own space, or if you're an investor exploring industrial property as part of your portfolio, do drop me a message with the word industrial. I will share with you the project comparison, rental pointers, and the key questions you must ask before you commit. Because in real estate, the best opportunity is usually not the loudest one. Sometimes they are the quiet assets that serious buyers study before the crowd notices. This is Sandra, and I will see you in the next video.